Hello, everyone, and welcome to our fifth session in our 10-part government CPE series. Today, we'll be talking about budgeting in a COVID world. I'm Stacy Dreher, Marketing Director for James Moore & Company, and I'll be your host. Our presenter today is Zach Chalifour, partner with James Moore & Company and the leader of our firm's government services team. He brings a unique perspective to government finance, having served as the contract finance director for a local municipality for the past year and a half. Zach regularly presents at the FGFOA Conference and School of Government Finance and at various local FGFOA chapters. He's a member of the GFOA, FGFOA, and several local chapters of the FGFOA. And Zach is also a CAFR reviewer for the GFOA. So Zach, without further ado, I'll turn it over to you.
All right, thank you, Stacy, and welcome everyone. What should be a pretty interesting and different sort of topic today. I know I've been out of my own personal comfort zone, normally working in the audit environment where we're always looking at historical data, the past, and just proving out that, okay, yeah, what this entity says happened for this past financial fiscal year is actually what happened. In this case, we're going to look really a little bit more at the current year that's in place and looking forward. So it's one where in that finance director capacity, being involved, it's definitely given me as an auditor by trade, so to speak, much more of an appreciation for what goes into all of you that are always in that finance director capacity, and really often sometimes have as many as 3 years that you're contending with, where you might be wrapping up an audit from the prior year, working to keep things in line in the current year, while also starting to look at your budget for the following fiscal year. So definitely a whole new perspective and a whole new appreciation for the work that is required. Nonetheless, what we're going to look at today, of course, the topic for today's session was budgeting in a COVID-19 world. As I've seen, in recent months, as we've started working through the budget process at the City of Lake Helen, I actually had our first budget workshop about a week and a half ago. Going through that process, talking with others, this is definitely going to be one of the most challenging budget cycles for local governments and many other entities that, for many of you, probably the most challenging you've ever faced, and for some of those who have been around for the past recession of 2008, 2009, maybe that compares, but just the pure unpredictability of what we're going to be looking at, to me, definitely sets up this upcoming summer as one of the most difficult, if not ever, budget cycles. So what we're going to look at today to kind of go through and just set the stage of really just where are we in this process, and then start looking at the revenue side and the expense side to hopefully just come up with a few different ideas, perspectives, strategies, and just put different thoughts out on the table to be mindful of and be aware of as we all work through, again, this very challenging process that we'll be going through the next few months. So we're going to look at first what we do know. We know a little bit, but it's still very limited. So just the general thoughts again of what do we know about COVID-19 and the impact that it's had on the finances of local governments and other entities as we go through this budget cycle. First and foremost, the situation is continuously evolving. I feel like it's not quite as rapid as it was back in March. I know in March it seemed like everything was at least on a day-by-day basis, if not hour-by-hour basis. Just seeing what was actually going to happen. Was there a large shutdown in many states throughout the country? I know the moment that stuck out for me personally was the evening where, as a big sports fan, it was first, I think, that the college basketball tournament was postponed completely and not going to be played with fans. Or first fans, then completely, and then the same night, the NBA announced the player had COVID-19 and suspended their season. The NHL, the same time as well. And in that period, around mid-March, it seemed like every hour you could go and refresh the news, and there was a whole entirely different update from anything that you had seen prior. So I think we're not quite in that day-to-day phase, but still at least week to week, if not just a couple days to a couple days, in terms of just the evolution of the entire situation and figuring out what might the impact ultimately be when we look at what assistance will there be, what expenses will there be, when is life going to get back to quote normal, and what is that going to look like. So it's one where even from when I put this content together about a week ago, there are some things that have evolved from what we knew at that point in time. So as we go through this, again, this is kind of at this point in time, some food for thought, but of course there's going to be many, many more changes as we go throughout this process. The one potential for bad news is we still don't know if things are going to get worse before they get better. The hope is that we're on a positive trajectory. Of course, the stock market has done well in recent days, and there's been some positive news with reopening. So we'll see how that goes, but still just so much uncertainty in terms of riding the roller coaster of good news and bad news, and just what the outlook will be, in 2 to 3 months from now once budgets are being finalized and millage rates adopted. Unemployment levels, we do know at least what those are, that those have skyrocketed. I've got a slide here, the next slide or two, that looks at just what those trends are and gives us a little comparison to what those numbers looked like, again, in the closest thing we've seen to what we're going through right now with the 2008-2009 recession. But the bottom line, this is just something that we've never seen before, and it's going to be impossible to predict. So as I mentioned earlier, I wish I had the answers, but this is one where it's just ideas and thoughts to hopefully help work through that process. But if any of us had the answers, we'd probably be very rich from the, buying lottery tickets if we knew how to predict the future. So looking at first the unemployment trajectory, you can see here in 2008, 2009, that number took a pretty substantial skyrocket over about a 1 year or so period, where you can see now in 2020, as we look at the impact from COVID-19, the unemployment levels went from something very, very low to almost 15% practically overnight. So in terms of looking at how quickly things have changed from a financial side, again, we've never seen anything like this where there's just been such a drastic impact almost overnight. Now, it's not one that we've eased into it and there's just a slow recession coming on. It's just been overnight. The world basically has been turned upside down, and we're all now trying to pick up the pieces and say, okay, how are those pieces going to fit together as we go forward, and figure out just what the financial position and activity is going to be for our entities as we go forward. So again, just accumulating different information on what has been out there in the last few months. The National League of Cities did put out a survey back in early April. So again, we're talking information that's about a month and a half old, so it has certainly changed to some degree. But I think these numbers of everything I saw in the survey seems like they were probably still going to be very comparable to what we would see at this point or estimate. So when municipalities were polled as to whether they expected a revenue shortfall, just about 100% said yes. They expected that shortfall, and as they looked at the cause for that, 96% of those said the revenue decline would be the major issue causing that shortfall. Well, a number picked both revenues and expenses, and almost half thought that the expense side of it would be a substantial impact as well in terms of what would cause that ultimate shortfall. Municipalities that said they expect to have to cut services to some degree to make ends meet and get through the COVID-19 pandemic. There were a couple different ranges in here, but the two that I pulled out is first those with populations under 50,000. It was about just half that at that point in time thought they would have to cut services. Those with larger populations of 200,000 or more, it was almost 3/4. As we'll talk about later on, looking at the revenue side and reserves, we talked about reserve percentages and what is more common to see in a smaller versus a larger entity. I think that does make a lot of sense. But again, either way, we're looking at over half envisioning some pretty substantial cuts in order to get through this time. And so what do we know in terms of any funding that's come out? What assistance will there be for local governments and other entities? At this point, the answer really is there's not too much out there that's going to trickle down into the government world yet. Of course, the key here is everything is always evolving. But for the major items that have been on the news a lot, everyone's heard about, the big one, of course, passed in late March was the CARES Act. And in the initial CARES Act, about a 500,000 population was a size for the initial cutoff to say if you were a local government, so generally speaking, it was states and some counties with a large enough population, possibly a few cities here and there were allocations to those local entities. So for instance, in Volusia County, we're on base with a population of just over that $500,000 or excuse me, 500,000 person level. The allocation was, I believe, about 96 million. Those allocations, as I went to the state of Florida and otherwise, all again in proportion to the population. So those state allocations, there of course then was a very large chunk of that CARES Act funding that passed through to the state of Florida. There's been talk about where that funding will go, and it's still very much a question mark in terms of how will that funding get passed through to local governments and what will be the restrictions on spending. We'll talk in a few slides and as we go throughout the session on some of those restrictions, what might be eligible uses of that funding, and really just how best to strategize as it relates to that funding, given again that it's continually evolving what those rules are going to be. Just to kind of give you an idea of how those rules keep changing, one of the biggest pieces of the CARES Act funding, primarily focused on small businesses and small nonprofits, was the Payroll Protection Program, or PPP program, where entities with under 500 employees could apply for PPP loans that are either at a very, very low interest rate, or for many entities, if sufficient dollars are used on payroll and related expenses, those loans can essentially function as grants and be 100% forgiven. The end goal of these programs was to help keep employees on the payroll, but the key here is on the PPP side, those were not applicable to local governments, so there was no benefit at the government level there. There's been some other programs out there, economic disaster grants or loans, I believe. And again, most of those, pretty much no impact on the local government side, very much driven towards the small business side. So as we look at the CARES Act and some of those major items that have gotten a lot of the attention, helping out smaller entities, let's say, even those small governments with just a small handful of employees, still no assistance related to those programs or anything to this point from the CARES Act. With regard to the CARES Act funding for those entities who have received it directly or other municipalities looking at potential pass-through of that funding, one of the challenges that I've seen so far is when you look at the authorized uses here that have been outlined in that funding for local governments, everything is really centered on the testing side, additional PPE for protective equipment. There is some allocation where it talks about personnel costs, but as you can see here, when it talks about the personal protective equipment and personnel costs, everything here is in addition to what you would have already budgeted for, what you normally have. So it's only what you have in excess of your normal budget in terms of what you're spending on those supplies or any time that's being spent related to the COVID-19 response. So that does not provide anything on the revenue side. As you can see at the very bottom here, it is a non-authorized use. There are some specific items that may be of consideration looking at telework improvements, as well as the one big one that's probably going to hit pretty much everyone as far as the social distancing measures. Any stickers put on the ground, plastic walls basically to help shield your employees from those that come in. Those, of course, are all eligible expenditures. But when we look at the millions and millions of dollars that are going to be allocated potentially for some cities and counties, the actual hard dollar expenses relative to that potential funding, in probably just about every case, is going to be substantially less. For me personally, that leads me to kind of hope there's folks out there lobbying to say that the revenue loss, as we'll talk about, from everything I've seen so far, is still going to be that primary impact of COVID-19 on local governments and many other entities. It's not like a hurricane comes through and there's millions and millions of dollars spent on debris hauling, and it's a very tangible expense. It's one where there's going to be a very tangible revenue loss when we go and look back at the fiscal year. And the question really remains, and is going to be out there in terms of where will that fall out? Will that ever become an authorized use of those CARES Act or other funding? There have been some instances I've seen where, when rumors are being thrown out there about what the federal government is looking at in the latest round of stimulus payments and activity, I've seen some rumors about the revenue loss being something that has been prioritized by some federal elected officials. But of course, until anything is passed, until those dollars are passed through to the local level, it's generally speaking not something to hold your hat on and expect to get at this point until we know any more. I just look at it as it would be a bonus, but we have to plan under the assumption that there will be no substantial assistance related to the revenue loss or anything really other than those, in most cases, minimal hard dollar expenses that can be directly related to the COVID-19 response. And looking at the revenue loss, as we start to try to quantify what that revenue loss is going to look like, the big area, of course, is sales tax collections and those monies that pass through the state of Florida. In April, the Florida Office of Economic and Demographic Research, or the EDR, their monthly revenue report showed that sales tax collections were down almost $600 million, or about a quarter of 124%, down from what they were expecting. As opposed, in terms of the total revenue loss, it was about $878 million when factoring in the other revenue sources such as gas taxes that also flow through there. We do have a link in here for those of you that might want to check out that full report. But as we expected, the impact has been huge. At the local level, as we'll talk about a little bit later on, looking at the city of Lake Helen revenues that came through, we were down about 25% looking at those sales taxes and otherwise. But the key reminder here for those of you looking at those May disbursements from the state of Florida is there's a 2-month lag on those sales tax distributions coming to the local level. Those collections by businesses in March get remitted to the state in April and then passed on to the local level in May. So when we look at that 2-month lag, while the May receipts are down, we have to remember that those May revenues relate to March. And if you think about when the shutdown in Florida and really in the country took place, it was pretty much mid to late March that things really started to shut down. And then April was the month that there was next to no activity. So when we look at what month will have the largest revenue impact, once we see those April dollars come through in June, that's really going to be, I think, what tells the story, at least in terms of what's the worst possible scenario that we might see in these numbers. I know I've seen some components of bed tax related to tourist development tax, where Orange County was down about 97% in their tourist tax revenues in the month of April. Volusia County was down about 80%, I believe I saw. And all of those impact a large chunk of the sales tax dollars as well when you look at what the short-term rental market does in terms of just being a huge part of the Florida economy. So again, we're still waiting to see what those look like. But the news so far has been every little bit that we feared in terms of the fact that there will be a pretty substantial impact to the revenues for local governments going forward. So what we don't know, there's of course much that we don't know. And first and foremost, is we don't know what the answers are going to be or really how to find the answers. It's going to be everyone's best guess at this point. The bottom line again is there is no magic 8-ball or any quick way to really predict what will the impact look like 1 month from now, a year from now. Best case scenario is, okay, in 6 months, there's a vaccine, it's been distributed, life's almost back to normal, and it's an afterthought. But that's probably very optimistic thinking. There's just so many scenarios that could be played out in terms of what happens in terms of a vaccine or a treatment, and how soon does it happen. Because looking at different time frames, it's one where it could still be a year before there's a widely distributed vaccine. There could eventually be a realization that there's no treatment. There's just so many scenarios that it's really impossible to say, okay, well, here's what's going to happen with the virus, so here's what will happen with the economy, and therefore here's a reasonable assumption to say, well, here's what our revenues are going to do, here's what expenses will look like, or anything of that nature. It really, at this point in time, everything is just a total guess, and there's so many variables dependent on what happens with the virus and otherwise, that again, it's just all going to be about making those best guesses. We'll talk about how much risk can be assumed, because depending on your entity, you may be willing to assume a little bit more risk in terms of what you could or have the capability of absorbing in terms of a revenue loss or additional expense or extended period of shutdown. And again, talking about what the impact on revenues will be, a huge part of it, as well as what the economic recovery looks like. Even if there is a vaccine that's come up with pretty in the near term related to COVID-19, the question still remains of what will be the spending habits of the country. Will folks get back to normal pretty quickly, and a year from now the economy is right back to where it was? Or will this be an extended recovery that takes a number of years, even beyond the period of the virus, and trying to get everything sorted out from the medical side of how life will continue again in a COVID-19 world. On the financial side, as we've kind of talked about, revenues, expenses, we really don't know what anything is going to look like at the end of the day for sure. As I talked about before, this is definitely, I think, going to be one of the most difficult budget cycles in a long time for finance directors, anywhere, given whatever type of government you're in, or those of you in other industries. It's going to be difficult as probably anything else, because there's so many variables and just such a large impact that could take place. I know we have many higher ed individuals attending today as well, and just looking at, okay, what are colleges going to do? Will students be on campus? Will they not be? And all of the impacts there, to say, okay, what about the employees who work in the food halls and restaurants on campus? What if students aren't on campus? Well, now there's so many different trickle down impacts. So when we look at some of these different factors, the biggest thing to note is just how many pieces are so interrelated. And once you change one assumption, it could change 5 other different areas pretty substantially. And again, CARES Act funding, what we don't know. We don't know what will happen in terms of, will those funds be able to be used for any other purposes. With regard to single audit, we don't really have many on the business side that I saw on the registration list, but the PPP loan program, they have the feds have said would not be subject to single audit, is at least the expectation right now. But for those of us that do have CARES Act funding trickle through, there's been nothing explicitly said, but the assumption here is that any funding received under the CARE Act will be subject to single audit. As far as what else is there, will there be FEMA funding assistance? Has been discussion, potentially some funding available, but it's still to be determined what the full scope might look like in terms of what those eligible expenses are, what the reimbursement process is, and so forth. I know many governments are still struggling to get dollars in from Hurricane Michael, Matthew, Irma. So FEMA is, again, not the spot that you want to have to rely on to be able to get through from a cash flow perspective or otherwise. And again, future legislation to help local governments, we don't know what that's going to look like, but there have been rumors, discussions about doing more to help smaller governments, as well as revenue loss potentially being on the table. So again, one can hope, but again, it's nowhere that we're ready to rely on or expect that assistance to come. Other industries, as I talked about on the higher ed side, we don't know if colleges will be on campus. There's also, will there be a football season? Athletics is a huge part of and revenue driver for many schools, and we just don't know what that's going to look like in terms of, will there even be games? Will they be held on campus with fans? We just don't know any of that. And from a grant funding standpoint, looking at the local government side or even nonprofit side, what kind of an impact might there be to any existing grant funding? Will some of that funding be lessened to reallocate in other areas? Those are some of the areas to really just think about, be concerned of, and say, okay, how much are we relying on some of these revenue streams? And what is the risk level that we see as far as those potentially being reduced or going away completely in a worst case scenario? All right, so before we get to the revenue side, we do have our first polling question. Stacy, I will let you take it away.
Sure. In just a second, you guys are going to see the poll. We'll give everybody a few seconds to respond. What percentage revenue loss are you expecting your organization may be subject to? Okay, we're going to keep this up for another couple seconds. Answers are still coming in. Okay, I'm going to close the poll and let's take a look at the results. So 5% of you said 0%, 25% of you said between 1 and 10%, 45% of you said between 11 and 25%, 23% of you said 26 to 50, and 2% 51% or more.
All right, so I think that does kind of fall in line with about what I've seen and what I've been expecting. In our budget workshop, we looked at some areas with as much of a 25% reduction. I did have an audit presentation just Monday evening where the question came up in terms of what should that dollar number look like. And 25% is kind of the number that I think is being thrown around the most, looking at some of those revenues that are most subject to impact from COVID-19. As we drill through different types of revenue streams in a few moments, we will talk about some that hopefully will not have much of an impact, but there's certainly some that may have larger than that 25% impact. So depending on the makeup of revenues for your entity, that's generally going to be what's going to impact probably whether that number is a little bit higher or a little bit lower. So looking at the different revenue streams out there for local governments first, we're going to kind of walk through almost, if you think about your income statement, we're going to walk through from property taxes all the way down and talk about what are the different types of revenue out there and what do we expect the ramifications to be of COVID-19. So first and foremost, property taxes. This is one where at least there is somewhat good news. The ad valorem taxes that will fund the fiscal year 2021 budgets, those of course are all based on a property valuation date of January 1st, 2020. That of course is before anything really started happening related to COVID-19, and therefore those values should continue to be pretty strong. I know in Volusia County, I believe there was an 8 or 9% countywide increase. So many governments, the property tax value side at least, hopefully you're still trending in the positive direction for fiscal year 2021. Now, to the contrary, one of the challenges I see is that it's always a battle, or not battle, but just hard decision to say, okay, property values have gone up, but is the tax rate going to just go down to rollback to basically generate the same level of revenue? Or will there be any opportunity to increase total revenues to the government? Because I know many finance directors, city managers, otherwise, there's always something that could be done with that additional revenue, whether there's projects that have been pushed off, whether employees are in need of raises. So that's always the challenge, to really figure out how to get that additional revenue that is so needed in many cases. But looking at this upcoming year, it's one that I see being a challenge in probably many cases where I would venture to guess probably 90% of local governments, even with those increases to the property tax values, looking at what that millage rate will be for fiscal year 21, I feel like in many cases it's rollback at best is going to be the scenario, because when you look at the financial ramifications of COVID-19 on families that are struggling to pay rent, pay their bills, or whatever, if there's individuals who have lost their jobs, you already have that financial pressure where folks are saying, hey, we need every break we can get. You combine that with it being an election year for many local governments, and I think combining all those different factors, there's probably going to be a lot of political pressure where rollback in some cases might be the best case scenario, and we've got elected officials looking to say, okay, but how much more can we cut because we've got to give the citizens a break. So of course, we'll see how that plays out. Every government will be different there in terms of just what the political environment is, on what the needs are, and where that falls out. But the good news, at least, is those values on probably just about every case should be higher, and at least provide that opportunity to help generate the additional revenue if it is ultimately needed as kind of a last case resort, to look at an increase even potentially to help offset some of the other revenue losses. Looking ahead even further to fiscal year 2022, the value impact of here, of course, would be at the property values as of January 1st, 2021. We don't know what those will look like. Everything I've been seeing so far has indicated that the real estate market has been pretty stable, despite I think there was a temporary decrease in the number of transactions, and that seems to have rebounded a little bit. I've even heard some suggestions too about the fact that the Florida real estate market in some areas, especially those of you that are not already in a big city, in a more rural or suburban area, that there is some optimism that the real estate markets in those areas may actually continue on the incline, for the reason that when you look at some of these bigger cities, especially all of the citizens in the New York, New Jersey area that live in parts of the country that are just so congested with people that there's really, I don't think, any physical way that you can even social distance if you were to try. And you look at those that rely on the subway to get to and from work every day, as opposed to most of us in Florida, you drive your own car wherever you're going. I have heard some talk about to what degree is there going to be this mass exodus from other parts of the country into Florida. That, of course, will have a whole other series of issues when looking at just growth management and everything else, if that does come to fruition. But that did seem like a reasonable scenario, and help provide some optimism to the fact that hopefully there will not be a substantial impact to property values related to the pandemic like we saw back in 2008 and 2009 in the recession, when property values tanked to the point that many property values now are just getting back to where they were back in 2008 and 2009. So hopefully that piece of the equation is not going to come to fruition. But again, that's something that should be monitored, and could come up as soon as next summer when looking at the fiscal year 22 budget, if there is still an extended impact from the pandemic. So as we talked about state revenues, that's of course really the most immediate, most significant impact for probably 90% of governments out there. Of course, looking at sales tax, shortfalls are without a doubt expected. I did talk about the 2-month lag, and it being really a 20 to a 30% decrease for most. We'll see pretty soon what those June numbers look like. And again, that will hopefully help paint the picture for the worst case scenario. But as we look to fiscal year 2021, really, again, the challenge becomes that, okay, if we said in May it was 20%, let's say June is 40% down, the question is just, where do you start? Because again, it's still such a large moving target. One thought that I would generally look to include as you go through is think about what's the best case scenario and what's the worst case scenario, to kind of say, okay, is the best case scenario just so good that you're comfortable going a little bit lower? And is the worst case scenario one that there's going to be major issues from a cash flow standpoint, debt covenants, or whatever else? So I think this is one more than any other case where you might have a 5% variability factor looking at projections in a normal year, this year the potential variability of where things end up versus what budget number is settled on is just going to be so much larger. That makes it so important to look at those best and worst case scenarios and have that comfort level with both, knowing what you would do in response to either scenario if it did come to fruition. So one budget strategy that I thought I would share in our budget workshop, we did have an Excel worksheet for the general fund where we have all the general ledger accounts listed and of course show the prior year numbers and what the preliminary working budget figures are. And one thing that we added this year that I thought I would just share a quick screenshot of to kind of show how it played out is, as we look at some of those revenues that will be impacted, one thing that I wanted to be able to do was to kind of account for all else equal. If we were not in this in the pandemic, what would that revenue figure look like? So for instance, on the screen right now, you can see at the very bottom, we have the sales tax revenue number of about $157,000. That number, I believe, was just the same number as it was budgeted for in fiscal year 2020. Rather than reducing that number by 25% or whatever percentage we looked at, I basically added a separate line item to say, hey, here's sales tax, but this is what we're going to call the COVID-19 loss. And we did that for revenue sharing, gas taxes as well. And then at the very top of the Excel worksheet, really we had a few different working assumptions. Some just looking at, okay, if we change the property value or we change the millage rate, what would the dollar impact be? And then we could see at the very bottom, what the end result would be if we had a shortfall or a surplus. But that very first line item there for the COVID-19 revenue loss, this Excel worksheet was programmed to basically say, okay, we've got that 25%, and then on those different revenue categories where we had the basically contra line item for the COVID-19 loss, all of those cells, so we've got that 39,227 negative, that's basically equal to the 156 sales tax normal working assumption for what those revenues will be times the COVID-19 revenue loss. So we've got those lines programmed in to just see what the impact is on a line by line basis. But then at the very top, there's a total dollar impact where $84,410 was the total projected impact of COVID-19 if we assume that those state revenues will have a 25% loss. So that really gave us a chance to say, okay, now that we can see the budget as a whole, let's be able to quickly quantify what do we think is going to be that revenue impact when we look at how much are we going to use in reserves to get through the current fiscal year. What might things look like once we get back to normal? So just a few thoughts there in terms of strategies to help identify that and just have that number in front of you as you work through the budget process, because much of the process is not just getting through fiscal year 2021, but also knowing that you're still in a strong financial position once you enter the budget cycle next year. Again, assuming hopefully much of the pandemic is behind us, but either way, always good to know and be able to quantify what those different impacts are. Another general thought to look at when you're looking at what your revenues are, one consideration I think is important to think about, and I kind of referred to this talking about the college situation to say, okay, are students on campus or are they still remote, is what expenses are just fixed versus which of those are directly tied to any specific revenue activity. So I threw together a very, very basic comparison, but of something that could kind of show, okay, what kind of an impact are you going to be facing otherwise related to some revenues that may decrease. So the example I threw on here was, let's say we're talking about your building department. Do you have a staff, are you fully internally staffed where you've just got employees that handle all of that inspection activity? And again, this is probably more common in a smaller government, But do you have a scenario where much of your actual inspection activity, you've got an outside contractor and they get paid on a per inspection basis, let's say? So under this assumption, we're going to say in a normal year, revenue is about $1 million, expenses, whether that's being done in-house versus contracted is pretty much a wash. You know, you've got your budget kind of in place to be able to be balanced either way. Looking at a potential impact of any revenue stream like this under COVID-19 conditions, let's say the building department, you have reduced activity just because there's less going on during the pandemic. And let's say the revenue drops by 40% in terms of just having less building activity, less inspections performed. In the fixed scenario, there might be some direct expenses and that otherwise scale with activity of building permits, but you might be $300,000 in the hole looking at that immediate impact where you can cut some expenses, but there's not a lot that just naturally decreases. On the fixed side, excuse me, on the variable side, the impact might be that revenue goes down by the same 40%, but because there's much more of a direct cost that goes along with some of those revenues, there might also be a natural expense hit where your net that you're having to make up related to that impact is not as significant. So this is just kind of one very, very basic example to kind of help illustrate the concept. But as you look at different revenues that will be impacted to some degree, I think it's important to also always take into account the expense side of it and say, okay, what impact will there be related to these revenues? Are the expenses going to go down as well, or are these revenues basically coming off the top and going to create a substantial shortfall? So I talked about the building department activity. As we also look, there is the use of reserves that could potentially help get back through there. For local governments, there is a 4-year carry forward limitation on your fund balance related to the building department. This just went into place last year, but for any of you that might already have a kind of higher level of reserves than where it's supposed to be, this may be a chance to just use those reserves as you work through the pandemic and get those to a more reasonable level, or not more reasonable, but more appropriate based on those statutes. Looking at other fees, I talked about fixed versus variable expense activity. Really, I think is the biggest consideration when you look at other revenue streams and what the potential bottom line impact might be. Looking at franchise fees and non-ad valorem fees, I think so far it seems like most of those should be not have a large impact. Of course, the non-ad valorem fees just go on the tax bill, so there may be a slight collectability timing issue, but at the end of the day, there shouldn't be a large impact there. Then with regard to impact fees, that's another one where just what happens in terms of growth, is there a large impact or slowdown? That could have an impact on what those impact fees look like going forward. Looking at grants, in the short term, presumably there won't be too much of an impact, but the real question here, as I mentioned earlier, is you want to look at those recurring grant funds over the long term and say, okay, is there anything that might be at risk, and how ready are we to respond to the potential loss or reduction of those funds if that were ever to take place? On the charges for services side, primarily we're talking about utilities, water and sewer revenues. For the most part, it's been business as usual for many governments. Everyone still needs water. The real challenges, of course, have been how to handle delinquent accounts, how to handle shut-off policies. I know many governments held off on shutting off any accounts for a number of months. Many have begun putting those policies and practices back into place for those delinquent accounts. We've seen some situations as well with utility bill forgiveness where there has basically been a more or less grant to all customers to some degree to help get through the difficult times. So many different things that we've seen related to the utility side, but for the most part, outside of delinquent accounts, those probably are largely business as usual. One interesting trend just to be aware of and look at on the utility side, I think, is what type of demographics your government might have in terms of, are you primarily a residential community where people live in your city but they go work elsewhere, or is it the other way around? Because looking at the utility side, both I think in the short term and the long term, is there could be, for those residential communities, there could be some sort of an increase in consumption as you've got more and more people working from home, using more water, using more electricity than they would normally when they're outside working and gone from the house for 10 hours a day, as opposed to being home the entire day. So just some other different considerations to be thinking about for those in those types of areas, because there could be an increased demand on the utility system and many other factors at play. Thinking that some of those trends of working from home and otherwise, those may live on for many folks beyond the pandemic, because I know there's been some that have just proven they can do it and they actually like it, aside from just the avoiding the risk and staying home to stay safe. A few other revenue impacts. We've got some governments that do have beach parking. Many beaches were closed the last couple months until the reopening, so that's one where for some cities it is a general fund revenue stream. That's a pretty substantial impact. The hope here, of course, is maybe it's only an FY20 issue. Hopefully things don't get bad enough that beaches are closed. I know many looked at beaches as an opportunity to kind of get out of the house but still social distance, so that may still be a revenue stream, but just one to definitely, for those on the beach that do charge for parking, again, that's one that could have a huge swing downward if there is any sort of additional closure or otherwise. Looking at parks and recreation activity and event space and facility rentals, those are some of the ones that are probably going to have the most significant impact, where just as athletics might be canceled, folks can't use facilities for weddings or other events. Those could be some where there's a major decrease in revenue. And again, you've got to look at, okay, what is the expense related to those revenues and what's that net effect and how do you get through that? On the long-term side, of course, future customer growth, and otherwise will have an impact, either up or down, depending what the actual trends are in terms of folks that move into your municipality or area. So looking at just kind of, what can be gained as we look at some of these impacts and say, okay, we've got revenue losses, but what other impacts might there be? So as we talked about beach parking, for those that do have beach parking or anything similar, this is probably a good time to look at what are the fees and what makes sense from a market value standpoint. Could or should there be a larger charge for that access, as well as looking at resident versus non-resident prices and whether anything consideration should be given to that. Kind of the example that I look at here is, while most of the theme parks in Orlando are either have reopened or are preparing to reopen, what is going to be the consumer appeal of going to Disney for a day versus going to the beach? There may be some shift where more folks gravitate towards those outside activities, and maybe there is an increased demand that might necessitate a larger charge, even just to non-residents. Looking at any other assets that are out there that your entity has, just be thinking about, are there any ways to capitalize on what you have to help diversify a revenue stream, or really just provide a little bit more security and get the market value of what you have to offer. Of course, there's a balance where taxpayers don't want to pay for things or already pay via taxes, but could it be a non-resident situation or something like that? At this point, there's nothing that I would leave off the table. Investment income, everything peaked in 2019 for many governments. Interest rates have come back down. Really, the bottom line here is I'd always consider, look at your interest income and say, are you getting the interest that you could? Because if you're holding cash that's earning next to no interest, there's a good chance there is opportunity to have that cash work for you a little bit better and just get a little bit of extra income coming in on the interest side as well. Other revenue opportunities, when you look at the revenue audit side, and this is also, we will be looking at the revenue audit environment in a few presentations early in July. Tourist development taxes is a lot of what we'll be talking about, but look at any franchise fee agreements or variable revenue streams that you have where there might be a variable percentage of sales that you get from a tenant or something like that, and say, is it time to go in and audit those contracts and make sure that all of those monies are appropriately being remitted to your entity? And with regard to purchasing cards, we've seen more and more governments moving towards having a pretty robust P card program because of the cash back that you can receive. Just like from a personal level, you can get up to 2% cash back on some credit cards. We would highly recommend looking at that on the government side as well, and maximizing the use while maintaining good internal controls of those P cards to maximize any potential rebates. With regard to quick look at other industries, on the higher ed side, we talked about athletics, tuition, housing, depending on whether or not students are on campus. Of course, donations in both the higher education and nonprofit areas. Just it's a question of what will be the impact, what extra liquid funds will folks have to be able to give for charitable purposes, and how will that play out with regards to the economy. With regard to revenue alternatives, again, we talked about looking at just the proper pricing of those beach parking or other fees that you might have in place, and diversifying revenues. We do have on here short-term debt financing. It's kind of the last resort, but one of the fun ones looking at just the what else is really the monetizing of existing capital assets, or what do you have, what value might there be to outside individuals. And just a couple weeks ago, I did see an article and posting that the minor league baseball team in Pensacola basically put their baseball stadium on Airbnb for $1,500 a night for an opportunity to go sleep in the clubhouse. They had basically converted to, I think, have 10 beds or so, with the ability to eat, go on the field, have play on the field, batting practice, basically have a minor league baseball stadium to yourself privately for a day. So whether there's municipal owned facilities for those in the higher education and athletics side, when you look at football stadiums or otherwise, there might be tons of opportunities there. So it's one where think outside the box, look at what assets you have at your disposal and say, well, is there anything that might provide value and be something different that could help make ends meet, while also just providing a valuable and different product to those outside of the organization. On this front, we will be talking more about this and other higher ed specific items in the James Moore News and Brews series. That is Thursdays at 4 p.m. I did think I'd just briefly share that. Katie Davis, one of our higher education athletics partners, leads that series, and there's lots of good content there as well. Lastly, on the revenue side, looking at reserve policies, the GFOA, of course, recommends having a bare minimum of 2 months in reserves in the general funds. Some internal policies might be higher. And one thought here is if you do have a reserve level that is higher than that minimum, or you've got at least a few months in reserves, there could be some consideration to saying, okay, to what extent do you have those reserves in place, and are you able to fund those to help cover that revenue deficit or other impacts of COVID-19? Because again, the bottom line is hopefully most of these financial impacts, they will be a short-term, one-time or two-time type items. So when you look at it, one area I've kind of tried to visualize it is looking at it as substance over form, where, again, we talk about a hurricane, those debris expenditures are very tangible and easy to quantify, but the loss of revenue, it's intangible. You can't really touch it. You just know you didn't get it, but you didn't get it and then pay it out. But it is one consideration to look at, because again, it hopefully is a one-time item. So if you look at what your maximum potential revenue impact might be, and you have the reserves to basically cover that on a one-time basis, that may become a strategy as well that you use in looking at the next fiscal year. All right, so with that, Stacy, I'll turn it over to you for our second polling question.
Sure, thanks, Zach. All right, in just a minute, you'll see the poll. We'll give everybody a few seconds to answer. So what cost control measures have you already taken or explored in response to COVID-19? Right, it looks like about half of you have voted, so we'll leave this up for a little bit longer. And as a reminder, if you're not able to answer the polling questions, just submit your answer in the Q&A panel. All right, it looks like almost everybody has responded, so let's close the poll and share it. So it looks like 3% of you said layoffs, 2% pay reductions, 59% hiring and or salary freeze, 25% deferral of capital expenditures, and 11% other.
All right, so hiring and salary freezes, the most popular with over half, definitely a very common one that we've seen. Before we get into some of the specific areas, a couple just general rules of thumb that I did want to talk about. If you have any unnecessary or non-critical expenditures, those of course are kind of an easy initial focus area. But as we talked about, again, those fixed expenditures where you have revenues that are generally very directly tied to those, whether it's a building department, parks and rec, or similar, those are some of the areas where you really are going to want to take the hardest look at figuring out just how that's all going to fall out and how to make things balance. The other rule of thumb I want to harp on, primarily from just the financial side, we think about it, but it's one that can really be applied to any department, is looking at the short-term plan and the long-term plan, but in doing so, looking at not cutting any corners related to the short term to say, okay, one thing that we often talk about is, okay, it was great you saved 5% of the budget because there were lots of vacancies, but with vacancies you have turnover and then increased risk of internal control failures or otherwise. So in many cases, what may be a short-term saving might not have that same effect in the long run. So here is looking at just the short-term decisions with long-term consequences. As we suggest here, if you have any essential positions, generally I would try to do everything possible to avoid eliminating or freezing those positions unless it's absolutely necessary. Did have a little chain of reaction here to say, okay, on the finance side, if there's key positions unfilled, people might be overworked, then internal controls aren't being followed, and you've got a substantially increased fraud risk or otherwise. And again, the cost of any fraud or other issues that may take place, again, in any department, you don't want to have those ever outweigh the short-term benefits that you had, or you're just right back where you were to start. Looking at the internal control environment, if there's any structural changes made related to any layoffs or otherwise, the advice here, always reassess those controls and say, okay, what new risk might we be subjected to based on having made those changes? So on the personnel side, this pretty much aligns now with what over half of you said were the major impact so far. Layoffs, of course, are the worst case scenario if anyone has to be completely dropped as an employee. Other strategies, hiring and salary freezes, of course. The couple that could be a little bit better balanced, if possible, to achieve. First looking at furloughs. The idea here I wanted to share was looking at kind of the voluntary win-win, I called it furlough. To say, is there any incentive that could be provided to employees to help get through a difficult time? Let's say there's just a lack of work in whatever department or industry or whatever the impact is. Maybe there's a chance to reduce someone's hours by 20%, reduce hours by 20%, but only reduce pay by 10%, or different things like that, to kind of say, well, you give a little, we'll give a little, and make it work for everyone to help get through this difficult time together. Monitoring of overtime, of course, is one to always think about, just because you do have that additional cost when overtime is being incurred. Related to overtime, if there's an opportunity to leverage part-time or temporary employees, that could be something to look at, again, at least in the short term. If it helps you get the work done, but you're not absorbing that benefits cost or the recurring liability to pay that individual. With regard to the organizational structure, this may be a time as well to look at your organization and department structure and say, is there opportunity to collaborate between different individuals? Is there any restructuring that makes sense to kind of consolidate two department heads into a single position or anything of that nature? So probably no better time to look at that, especially if there's any positions that are currently vacant. Of course, as you look at any layoffs or other impacts, one of the considerations, again, looking at the fraud risk and otherwise that we love to talk about as auditors, is think about what's going to be the impact on morale, and will there be any resulting fraud risk related to that? Because of course, when you look at the fraud triangle, one of the in addition to opportunity, there's also rationalization. And if you've got some individuals that are not happy or with friends that someone who was laid off, there may be these negative feelings that could potentially drive fraudulent or unethical behavior. So again, always consider that as part of the risk assessment and be ready for what those impacts might be of any changes. So some opportunities that we can talk about on the effectiveness of personnel and really efficiency, look at if there's any opportunity for employees who might be in an area that is not actively doing as much. So let's say Parks and Recreation, there's no athletics programs going on, let's say. Maybe there's a chance to help in other areas and temporarily absorb some of the workload that might have to otherwise be done externally, get temporary help or anything like that. If there is any sort of downtime, look at training opportunities. On the accounting side, of course, Microsoft Excel is one that you can always get better in Excel, is what I've always believed myself, and I'm always learning despite feeling I have a pretty strong basis of skills in Excel. So always think about different areas that you can get more training or anything else in just to further the job specific skills, or otherwise once things do start to get back to normal. On the Excel front, for those that do use Excel, in 2 weeks, we'll have a webinar dedicated solely to Excel tips and tricks. And then internship programs, again, much like the temporary help side, just another cost-effective way to look at getting temporary help, while also providing a lot of valuable opportunity to students. Internships is generally for many a great way to get highly motivated and intelligent individuals to come in and help on a temporary basis. Some operating cost control ideas: consider going from a 5-day work week to 4 days. There could be some reduced personnel needs as well as just utility costs by not having the air conditioners running every single day of the week. Travel, of course, is a big one, whether it's conferences, other meetings. I know some schools are looking at athletic schedules and minimizing travel there. Second guess any travel that you have. Could you do it remotely? Is there a different way that you could travel? Anything of that nature. On the printing side, an office expense, printing is one that, just a question I have here is, how much of that printing budget that you have is truly necessary? Other areas to look at is mailing versus email. Do you absolutely need to mail XYZ, whatever it is that the standard process is to mail? For instance, I have a number of clients that every year we get mailed a copy of the audit purchase order. Well, that's 50 cents that local government spent, and I in a lot of cases already got it by email. So I get that mail, I open it, and it goes straight in the trash. So think about what you're doing from a mail standpoint and printing, and say, how many tens of thousands might be in those budgets, and is it really necessary? And again, if you're paying a lot of expenses with paper checks, we talked about P cards, also look at doing electronic payments by ACH so that you're not incurring, again, that stamp fee for every single check. It's more automated and lower risk, as well as saving the time and the hard dollars. On the procurement policy side, again, this may just be a good time to look at any opportunities to revisit that policy, look at some of those master contracts and make sure you're always getting or still getting the best pricing on some of those contracts. And again, as you have any programs that maybe should be reconsidered or any non-critical expenses, definitely look at those items as well. And one of the worst case scenarios, of course, if nothing else can make it work, is there's always the approach to say, okay, departments must make mandatory cuts of X percent from their budget, and kind of delegating that decision making down to those other levels with basically an ultimatum of what they have to be able to cut it down to. On the capital side, looking at the capital planning, there may be some consideration to look at what gets pushed off. I'd classify your capital plan items as really needs versus wants, to say, okay, what's critical, necessary, desirable, and optional, and then use that to determine whether those should be in the near term or whether you want to push those off. The other consideration too with capital needs is there's really no better time than now to explore debt financing. Interest rates are so low. So if there are any major capital needs that we're going to be funded by cash or otherwise, debt may be a great alternative or option to explore, because the cost of having, we've seen notes under 2%. So it's practically free money when you're talking about what the impacts will be of inflation going forward. With any internal charges that might be charged from the general funds to other funds or otherwise, this is again a great time to look at what those methodologies are. Are all of your allocations still appropriate? Is there something that should be reconsidered and maybe be shifted to another fund to really better approximate what the true cost is of providing those services? Likewise, if you have a utility fund that does not currently pay a payment in lieu of taxes to the general fund, that may be something to look at as well. Again, in terms of having really every fund pay their fair share and get things distributed as they could be. All right, and Stacy, I'll turn to you for the third polling question.
Thanks, Zach. Our third and final polling question for this session: what is your opinion on outsourcing services to the private sector? So we'll give everyone a few seconds to respond to the survey or send your response in the Q&A panel. Okay, we'll leave it up for a few more seconds. It looks like responses are still coming in. All right, it looks like most of you have voted. Let's see, 6%, it's great. There's a reason businesses make money. 79% of you said in the right situation, it can be a good option. 12% of you said only if can't be done internally, and 2% never.
All right, that sounds about right. I think we're almost 80% went with the, if it makes sense. So again, just probably a good time to look at what your different services are and whether you have those in-sourced or outsourced. Of course, you get more control and direct involvement when something is not outsourced, but if there is an opportunity to have cost savings or otherwise, it may be worth looking at outsourcing. So again, not any specific recommendations on what should or shouldn't be outsourced, but just it may be another great time to look at some of those key functions and say, hey, is there any opportunity to achieve additional efficiencies? Looking at essential needs versus non-essential, one other consideration is just engage the citizens in the budget process and their input to say, okay, what is essential, what's not, what would be the impact if certain services were eliminated? If there is a support that makes it much easier to potentially eliminate some of those services or make some of the difficult decisions otherwise. Likewise, I think it's important to communicate and always make sure it's kind of clear to say, okay, if we don't make certain expense decisions, what will be the impact on the millage rate? Kind of the three questions I have here in terms of whether or not an expense is incurred is, do you need it? Do you want it? And if you want it, do you want to pay for it? A few thoughts on other industries on both higher ed and nonprofit. Executive salary or highly paid employee reductions, always a consideration. I know there's been some talk about even eliminating sports, and again, the travel side being a huge part to say, okay, where can you cut and save some costs? And on the nonprofit side, the big challenge, of course, is some programs that are not supported by a grant or otherwise, do you look at potentially eliminating some of those programs that are a net negative and it just can't be absorbed any longer? So a few other thoughts on the cost control side is, just fixing what you don't know. Communicate with employees and engage them in terms of what is a way that we could save costs or anything else like that. And really think about who knows the process best. Generally speaking, it's going to be those who are actually doing it. With regard to employee involvement, just one thought out there is, solicit employee ideas as far as innovating, making improvements and decisions. For instance, here at James Moore, actually right now, we have an ongoing innovation contest where it's ideas to help improve the firm, change a firm process, and there's prizes involved. So consider doing the same in your organization, no matter what it is, where you really leave everything's on the table, whether it's a revenue idea, a cost savings idea, or a process improvement, and have some sort of motivation or reward for those that are selected with the best ideas that make a positive contribution to your organization. Some other quick opportunities on the government side for those with pension plans. And again, this is one that's somewhat outdated, but if you do make an annual contribution towards the end of the fiscal year, maybe consider making that contribution earlier. The market now is just about recovered, it seems like, compared to where it was pre-COVID, or at least at the end of calendar 2019. But if the market does take another nosedive, and consider making those contributions when the market is low, to have the pension plan be better funded and have a positive impact on the city contribution requirements going forward. We did talk about debt, where interest rates are just so low that it's a great opportunity to explore any potential debt financing. Leveraging technology, again, looking at many folks are working remotely. One big thought here is the electronic document retention. From an audit standpoint, we've had various audits that we've had to shift to doing those remotely. And I've heard from multiple clients that they basically said this COVID-19 pandemic is going to be what makes them switch to an electronic document retention plan going forward. With regard to efficiency, always look at what are the best practices. Is there any waste in the process that you have or what you're doing that could be eliminated? Lean Six Sigma, of course, is one concept here, and that's actually going to be our next webinar that we take a look at next week with some of the basic principles of Lean Six Sigma. So I definitely encourage everyone to attend that to help understand some other scenarios out there that could be considered. Again, communication, I think, is key. Looking at the volatility and communicating that. What's the best case scenario and what's the worst case scenario? The risk factor, depending how much your organization is willing to take on. If things do go south with regard to revenues, that will have a huge impact in where you end up, as well as what your reserves are will impact what your risk tolerance is. And collaboration, always encourage that. Talk with your peers, talk with others, see what others are doing, because again, we're all in this together and nobody has the right answers. Lastly, a little bit of luck can't hurt. Like I said, we're all trying to figure out what things are going to look like. So here's the good luck for everyone, and hopefully things work out for your organization. And we're all going through this process next year. This will all be a thought that's totally behind us. So as I mentioned, next week, our next webinar will be taking a look at Lean Six Sigma with Mike Sibley, a partner who's a black belt trained in Lean Six Sigma. So Stacy, I will turn it over to you if we have any questions.
Thanks, Zach, for taking the time to walk us through this information. We are out of time and we do not have any questions. So we're all good. Here is Zach's contact information if you'd like to reach out to him directly. And on our last slide, we have the remaining sessions in our CPE series. So if you haven't already registered for them, we encourage you to go to our website and sign up. So thanks everyone for joining us. We hope you have a great day.